Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Jason Thomas of Carlyle writing, the job displacement, productivity gains, and agentic economy expected to upend our world have yet to materialize. The current AI-related capex already accounts for more than 1/3 of the second quarter 2025 U.S. economic growth. Jason joins us now. Jason, always wonderful to speak with you. Thank you for being with us. And to me, this is the big question that so many people have underestimated for 2025. How much are we actually seeing that AI tailwind come into practical effect versus still remain a promise?
Well, I think it's interesting because when you think of AI, when you discuss AI, it's almost exclusively about the future and what it means. And that, I think, distracts from the present, just how important all of this spending is. Stacks, servers, GPUs, physical construction, and of course, electricity, related energy needs, related applications. And this, you have 4 companies now that are intending to spend over $300 billion this year. About 6 are spending over $400 billion. This went from something that is market significant, stock market significant, to something that is now GDP significant. And also, I think, underappreciated. It's also increasingly significant for bond markets. Because, if we look a decade ago, these large companies, they were largely virtual companies. Prior to the pandemic, this class of businesses, only about 20% of their book value was property, plant, and equipment. Most of it was really just cash, security holdings. Now, property, plant, and equipment accounts for over 70% of their book value. There's an industrial feel to some of these businesses as they ramp up their capital spending, and that huge surpluses that they used to generate, that providing liquidity to the rest of the economy, is now being rolled into to capital spending AI.
So, Jason, just to sort of bleed through into the market, what you're saying, the industrial revolution that so many people say is taking place, are you saying that is the physical world sucking capital out of financial markets, in particular the bond market, leading to higher yields?
Exactly. Again, what's so interesting, I think, is that these companies have really exercised an option to change strategy. In the past, it was typical to generate $100 billion of cash from operations, reinvest maybe 12 to 15 billion, and then that free cash flow would, of course, lead to a massive war chest on the balance sheet, or it would fund huge share repurchase programs or special dividends. Today, that revenue is being diverted to CapEx. And so this raises really interesting questions, such as the cash generation potential. We saw in Alphabet's earnings a big divergence between net income and free cash flow. It also raises industrial era questions about capacity utilization. And also, what is the economic rate at which this new capital depreciates? Is there functional obsolescence when you're investing at the frontier of new technology? How quickly does it arrive? So these are, again, very interesting questions. But from the bond market perspective, when you look at the cumulative cash flow surplus of the corporate sector this cycle, it's down 75% from where it was a decade ago. So the last cycle, there's a question, very large deficits. Why was it so easy for the Fed to fund itself? Well, of course, QE is the simple answer. But I think behind that, you also had, again, this enormous corporate savings glut. Some of that was cyclical, the scars from the GFC, but a lot of it was that most of the growth in earnings and revenues were attributed to, again, these virtual businesses that could grow revenue without incremental hiring, incremental investment, and they've changed strategy.
So, Jason, it's some serious tailwinds and changes we're talking about. But as you underscored, it's only a handful of companies. It's only 4, maybe 6 companies, hyperscalers, that are leading this charge. Is there a concentration risk in this, that these trends are being driven by a small cohort that for now are being rewarded by markets for spending? What happens if that changes?
Yes, of course there's concentration risk. There's concentration risk in the stock market. There's concentration risk in the economy, again, as capital spending and GDP become more dependent on these continued outlays. And I think that people talk about the Mag 7, of course, and it's the share, I think, 15% of global stock market capitalization, almost a third of the S&P 500 market capitalization. But I think that what's more concerning, to me at least, is that these are not a diversified set of businesses operating in completely different sectors with completely different strategies. They're all basically pursuing the same end goal at the moment. There's some variation, of course, but in general, it's a concentrated bet on the same AI future. And everyone has to hope that ultimately it pays off, because again, it's not just of significance for the stock market or investors in these particular companies, but again, it has very significant spillovers on the rest of the economy today as well.
Well, some of those spillovers, Jason, which has been widely talked about, is what it does to this labor market. And there it's unclear what's really showing up. You see it in some of the earnings. ServiceNow, the management platform tool, the CEO there saying yesterday, we're slowing down the hiring in jobs that are, quite frankly, soul-crushing, which I think is maybe a nice way to describe replacing people's jobs with AI. Jason, is it showing up anywhere?
I think that most of the change in the labor market that we observed in 2025 was related to tariffs, just the shock, the uncertainty. And I think what was so interesting about that was CEOs really not panicking. After April 2nd, I think there was this intention to project a sense of normalcy, to look at competitors and see if there were any missteps, if they could take market share. And part of that had been, yes, perhaps slowing the pace of hiring, but it was just interesting when we looked through our portfolio that there really not much of a reduction in open but unfilled positions. There really wasn't the pullback that I think many people expected. So the labor market has held up reasonably well. And of course, on the other side of that, you have inflation. That continues, if you look at core PCE over the last 12 months, still probably 2.6%. So, it is this interesting moment where I think that inflation's a bit stickier. I mean, of course, some people look at the last 8 to 10 weeks and tell me inflation is only up by 1% annualized rate. But, of course, there's not that many prices in our economy that reset that regularly. Whether they're fixed for contractual term or just other frictions. So it's a 12-month inflation benchmark, and it's still elevated. So, next week, I think, is a time when the Fed is very reasonably going to keep rates steady.
Jason, you're making an argument for why stocks can outperform and bonds cannot. The idea that the promise of the future and all of this investment and the profitability is much more attractive than credit markets that people say, or I would say government bond markets. Credit markets might be slightly different. Is that accurate? Is that kind of the way you think of the world right now?
There is, of course, the convex upside of earnings, of the potential of AI. And that is what equity markets are ultimately betting on. Whether that materializes or not is a separate question. But there is that upside there. And I think also just the potential for inflation. When you have businesses that can increase prices proportional to the overall increase in the price level, that also provides an inflation hedge when you're investing in businesses. The fixed income markets, that's a different story. Right now, if you look at the size of the U.S. fiscal deficit, it's consuming about 40% of the savings of the private sector. That is the savings of the household sector plus the free cash flow of the corporate sector. This is up about 50% from where it was in the past cycle, the 2009 to 2019. So this is just enormous funding needs. And I think that people have to be concerned about the potential to be inflated away. Eventually, the Treasury may try to term out more of its debt issuance. And what is the market clearing price when the share of federal funding actually moves in the direction of 10-year notes, 30-year bonds? So I think certainly a lot of questions there. And I think the other big concern bonds historically have hedged equity market risk. That was the experience really since 2000. What we've seen since the Fed started hiking rates in 2002 is that stock and bond returns have been positively correlated. Right. So those treasury holdings that you thought were protecting you, that would rise predictably when stocks sell off, are actually selling off at the same time. And we saw that, of course, in April, which many people attribute to the decision to suspend the initial Liberation Day tariff schedule.
Jason Thomas of Carlyle, thank you so much. Francisco Blanch of Bank of America writing this. We project Brent and WTI to average $67 and $64 a barrel respectively in 2025. Francisco joins us now, and I guess that you could ask, why are prices not lower, considering all of the supply that we see coming out of the Middle East and this push for drill baby drill in the United States?
Thanks for having me, Lisa, once again. Yeah, it's funny, right? So we're a weaker dollar. We're getting slightly lower oil, potentially lower rates at some point, right? It's all going according to plan. I do think one of the issues that has been supporting oil has been the seasonal strength of the summer months. But as we go into the second half of the year, we are going to likely see lower prices, and that's because inventories are most likely to build outside of China. Remember, in the second quarter, we had a surplus, but 97% of those barrels were stored in Chinese strategic reserves. And can you blame them after all the volatility we've seen in the Middle East, Russia, Ukraine? So the Chinese are acutely aware of the geopolitics and the fact that they're the biggest oil importer in the world, so 12 million barrels a day. So they have a huge exposure, whether it's the Strait of Hormuz or Malacca. They still rely heavily on oil despite all the electric vehicles that they keep pushing into their market. So I think that's been part of the story. My sense is they'll keep building inventories, but they almost have 40% of all oil stocks globally at this point, crude oil stocks, that is, right? So I do think second half of the year, the surplus is going to be close to 200 million barrels, and eventually we're going to spill out from Chinese inventories into the Atlantic Basin, into the U.S. and Europe, and that's what's going to allow prices to come off. How much are we going to come off will depend on how much OPEC Plus keeps pushing barrels out, because we've seen the rig count in the U.S. is already coming down, it's down 15%. So my sense is that we'll see lower prices, but not necessarily prices crashing.
Given the geopolitics and given the supply-demand dynamics that you were just talking about, how divorced is the price of oil from an economic cycle that seems to hinge on a new industrial revolution that 10 years ago would have included a huge use of oil?
This is a very, very good point. And when you think about the energy demand we're seeing today, it's in some places in the U.S. is astronomical. I mean, Texan power demand is up 5.5% year on year. I mean, you can barely find an emerging market that's growing at that pace, right? I mean, this is like insane. So I think if you look at the next few months, the majority of the demand, and probably the next 2-3 years, the majority of the demand for energy is going to be still renewables, also natural gas, which is what makes us relatively constructive on Henry Hub, and even into the summer on TTF, European gas. But for oil, it's not going to touch it immediately. It's going to take a little longer. I'm not even sure. Oil is a transportation fuel for the most part. So it's kind of left by the wayside in this AI revolution for more energy at this stage. Maybe later on it may not, but for now it is.
Can you talk about that later on point? What could it eventually look like?
Well, I mean, I think if you look 5 years out, the demand growth rates we're seeing for energy, they're going to be pretty hard to meet. And remember how we've evolved. 2 years ago, the big tech companies were looking for clean sources of power. They're like, we just want to use super clean power, and then renewables and this and that. And then they said, well, maybe renewables and nuclear, and now it's like renewables, nuclear, gas. Now it's like, just give me any power you can find, because we really need a lot of power. So there's talks about building 10, 15 gigs of power in Pennsylvania. There's, you have the Eastern Border is going to need a lot of power. Texas already, growing beyond belief, and even other parts of the U.S. where you have these data centers Pacific Northwest, you're going to have a lot of growth. And then eventually Europe as well. And the U.S. has a capacity problem. The U.S. needs to build those power plants. Europe, because it's destroyed its energy consumption in the last couple of years as a result of Russia-Ukraine, actually it does have the capacity. So it's going to be an interesting balancing act in the next 2-3 years for power too.
Well, just on that point, we finally have a ban on Russian imports coming into effect for Europe. And Total Energies, one of the biggest energy players in Europe, was saying, look, we have a tightening diesel market because of this.
Right.
How played out is this? Is there going to be more stress and tension in the market and tightening of supplies as the ban really starts to come into force?
There could be, certainly. And you also have to ask yourself, okay, so there's this ban on secondary resale, because the issue is, of course, Europe doesn't want to buy diesel that has come from originally Russian crude oil, which, as we know, is going mostly into India, but also into China, right? So Europe's been buying oil from refiners that actually do purchase Russian crude, and that's been one of the issues. But Europe still purchases 15% of its gas directly from Russia, right? So that goes for Belgium and France and Spain and Italy. And does it make its way into Germany too? So Europe is trying to really cut its dependency on Russia, but it's a tough thing to do because, again, only 3 years ago, or 3.5 years ago, 50% of European energy, oil, gas, and coal, came from Russia. So they're trying to do it progressively. And in the process, it's not been helping European industry, but that's kind of, I guess, part of the price that Europe is ready to pay.
Francisco, before we let you go, I'd love a comment on gold, the solid gold, the solid oil that we've seen in terms of just how people are treating it. We've seen prices double since 2022 to more than $3,000 an ounce. And I just wonder how much higher you see it going as you hear an increasing amount of people point this out as the haven asset, as there are real questions around fiat currency.
Right. So we have to be clear. Just like we are bearish on oil and we're constructive on gas because of the power story, we are bullish on gold as well. We think gold is eventually going to get to around 4,000 over next per ounce over the next 12 months. Having said that, gold needs more investor demand. The story has been mainly a central bank story, and of course, there was a nice tour yesterday of the Fed building. We saw that, right? So the pressure is on for the Fed to cut rates, and obviously people are going to question independence, and one of the beneficiaries of that questioning is going to be the gold market, right? So to what extent this this pressure builds on the Fed, political pressure, I think that's what will ultimately trigger a higher price for gold. But remember, jewelry demand for gold is down 20% year on year. So the real beneficiaries year to date of the gold upside pressure have been the other metals, the other precious metals like silver and platinum and palladium. So gold is doing well. It's still picking up momentum, but it's already a $20+ trillion market, right? There's $20+ trillion worth of gold out there. Remember, U.S. Treasury is in the hand of the public. 20 trillion or so, right, in the U.S. public. Now you have the foreigners, which own another 9 trillion. But gold's gotten very big, and to get another leg up, you need lower rates. When this happens, and particularly if those lower rates come on the back of political pressure, I think gold will get another leg wind. All
I can say is we saw a tour of the Fed. I would have loved to see a tour of Fort Knox. That's all I can say.
That's where they should meet next time.
Exactly.
Powell and Trump at Fort Knox.
I would like to see that tour. Francisco Blanch of Bank of America, thank you so much. Great to see you as always. Gregory Daco of EY writing this. Economic activity is decelerating. Even as inflationary pressures are reemerging, this tension is likely to persist through the summer. Greg joins us now. And Greg, we just had a lineup of people all saying that the economy is going strong. Mm-hmm. People are just deciding which fast casual restaurant to go to. And there definitely does not seem to be the same kind of inflationary pressure that many people thought would be the case. Why are you maintaining this idea of a stagflationary push that just hasn't shown up in the data yet?
Well, I think it hasn't shown up in the superficial data, but if you lift the hood, you're going to see the signs of this stagflationary move. If you look at the recent developments in terms of inflation, we estimate that about a third to a fourth of the push in inflation in the month of June was actually coming from tariff-induced price pressures. So it's there, it's slowly starting to emerge, and I've written in the past about the fact that it's not that we're not seeing the tariff pressures, it's that they're taking some time to filter through, because businesses have been managing inventories, because they've been using bonded warehouses and foreign trade zones, because the effective tariff rate is not quite yet at the average tariff rate, and there is a gap between those two. All these measures are delaying the inflation pass-through, but make no mistake, it is materializing, and it will affect us with more and more pressure over the course of the summer, which will feed into how consumers spend. And we're seeing these signs of pressures on the consumer already. If you look at retail sales, the categories that were most affected by the tariffs are the ones that are suffering the most.
So what happens then if we feel the real effects later this year and early next year? At the same time, we're starting to get Fed cuts, and you're starting to see the one big beautiful bill, some of the stimulus flow through from that.
Well, I think it's important to distinguish all of the different details that are affecting the economy. There are a lot of cross currents which make for this very confusing economic picture. But the reality is that the economy is decelerating. If you look at the labor market momentum, it is actually decelerating. Slower job growth, more concentration of job growth in a few sectors. We are seeing continuing claims for unemployment that are rising, even though after the hump we saw initial claims come back down. We're seeing the hiring rate at a 10-year low. All of these factors are factors that drive income growth, the key pillar to consumer spending activity. And that is weighed to the downside. So that's going to be a constraint for consumer spending as we navigate through the second half of the year, at the same time as inflation pressures are ramping up. And about that fiscal bill, that is not going to provide a lot of stimulus in terms of the U.S. economy. The major thing the One Big Beautiful does is prevent the expiry of a number of tax provisions from the Tax Cuts and Jobs Act. That prevents a drag on the economy of 1%. But the actual net boost to the economy, we calculate will be around 0.2, 0.3 percentage points of GDP. Not a big benefit for the cost of that bill.
Well, the other factor to put into this too is also what we might see in terms of a supply shock to the supply shock in the labor market, going from something like 4 million people coming into the U.S. a year, a lot of them working age men, going to something like just a few 100,000 per year. Have we started to see the effects, and what will the effects be going forward?
I think that's a much under-discussed topic, the immigration topic, because we are in an environment where increasingly economic activity is driven by supply-side factors. Whereas before COVID, it was all about demand-side factors. Now it's increasingly about supply-side factors. It's the supply of labor. It's the supply of capital. It's the supply of energy. It's trade and logistics. And when it comes to immigration, you're absolutely right. It's been a key driver of economic activity. If we start to see less immigration, that is going to do a couple of things. One, it will weigh directly on spending because there are fewer people that are spending less, in part because they're fearful. And two, it drives lower supply, lower labor supply, which weighs on employment growth, which weighs on your economy's potential to grow. Combined, all of these represent a drag of about 0.3, 0.4 percentage points over the next year. That's more than the One Big Beautiful Bill that we were just discussing.
It's one reason why people are looking at this miss on capital goods orders that include non-defense aircraft as being particularly notable. Stay close, Greg, for 1 second. Michael McKee, you've got some more details on what exactly was behind that.
It is sometimes fairly easy to figure out durable goods orders when you have these big swings. It's usually Boeing. They reported a decline of 51.8% in new orders for the month of June, Boeing and some of the smaller little private plane makers. And that compares with a 231% rise in the month before in May. So you can see why we get these big swings. Unless you're Danny Berger, you're not buying a new Boeing jet every month. We also saw a decline in manufacturing orders of 12.8%. That's something the Fed will keep an eye on, along with computers and communications equipment. They both were down on the month, and this may signal that business is sitting on its hands. One last note, capital goods shipments were up 0.4 after a 0.5 rise the month before, and that was double what was anticipated. So maybe we have a little more strength in the second quarter, the rebound from all those imports, et cetera, that we saw in the first quarter. Those numbers will feed into better than expected, perhaps second quarter GDP, which we get on Wednesday when the Fed is making its decision.
Thank you so much. Michael McKee and Danny Berger is here to tell us all about your selection of Boeing jets that Mike somehow put on your radar.
Apparently every month I'm buying a new Boeing jet. You all are welcome to join, I guess. I don't know where we're going with an entire jet, but yeah.
Well, but you know, what Michael is talking about is actually really important, and this idea that we've heard about so much this morning, which is that it used to be just investment in assets and liquidity-heavy kinds of corporate investment. Now we're talking about real physical investment in this whole industrial revolution. At what point do you see that really offering a boost to both productivity as well as growth that hasn't been accounted for in so many of the more pessimistic outlooks for the U.S. economy?
Well, I've been an optimistic on the productivity front. Despite the fact that I'm quite reserved in terms of the short-term cyclical outlook, I've been very optimistic about the exceptionalism that we were seeing going into 2025 because it was driven by strong productivity growth that was coming from the bottom up. It wasn't yet the AI lift that we're all talking about. It was actually businesses being more efficient with the talent on hand that costs more in today's environment, ensuring longer tenure, better trained employees are better able to contribute to economic activity. And it was this focus on investing in the infrastructure that will support AI. That is often undercounted. And then on top of that, you have a desire to push more industrial policy and focus on driving more manufacturing investment. It won't bring back the jobs, but it will bring back more economic activity and more potential supply. That is right now undercounted, but it is still one of the key pillars of economic activity driving that stronger productivity momentum.
Does that mean for all the fears of growth slowing and inflation picking up that it's not quite stagflation? Because you have some of these forces, it would moderate the worst case scenario?
Well, I think economic activity is a flow notion, right? And so we are still benefiting from a very robust economy. As I was saying, up until the start of 2025, we had an economy that had been growing at a 3% pace with disinflation. Inflation was moving lower. So we had the best of both worlds. We had essentially strong productivity growth supporting a very strong economy and disinflationary currents. We're gradually moving to the opposite of that, a stagflationary environment where economic activity is slowing and inflation is accelerating. And that becomes a headache for policymakers around the world, but including the Fed, which has to balance these divergence pressures in terms of the employment mandate and the inflation mandate.
Considering the pressure from the White House, inevitably, especially next year when we have a Fed chair appointed by President Trump, does this just turn into a Fed that puts more weight on the growth side of the mandate, even if inflation is still picking up?
No, I think the Fed will have to pay attention to both sides of the mandate. That is what it's supposed to do. But it has to determine whether the pressures from tariffs are one-off pressures, which is the argument that Governor Waller has been making. It's the argument that I've been making for a while now, that essentially this tariff-induced inflation is going to be a temporary one, that we are still seeing significant disinflationary currents, in particular from the shelter side of the economy, that inflation expectations are still well anchored, and that we're not necessarily going to see second-round effects because the labor market is softening and you're not going to see the types of pressure that we saw during COVID with wage inflation accelerating. In my opinion, that opens the window for the Fed to neutralize monetary policy from a slightly restrictive stance to a more neutral stance with some easing over the course of the next few months.
Greg Daco of EY, thank you so much. Vishal Khanduja of Morgan Stanley writing this. Given the tariff revenue collections, we believe that the next two inflation prints will be reflective of the tariff contribution. Vishal joins us now, and I am curious about whether this is going to be a one-time price shock or whether this is going to have longer legs and how much we've really gotten clarity versus just people's expectation that this will be just a one-time adjustment.
Good morning. Lisa, definitely in principle, it should be a one-time adjustment. Again, tariffs, there are only three spots that we can see the effects. Either the exporters eat it up, either companies through their profit margins. We heard a couple of those in the earnings, more on the auto side and the OEM side showing up with one-time charges there, or it trickles through PPI and CPI here in economic data. We saw a little bit of all of that less of exporters, more of profit margins, and CPI show us a little bit. I think as you track the revenue from the tariffs and as average rates start to go through the economy, I think the next two prints are going to get a little steamy and a little bit more contribution from there. But we still think it's going to be a one-time bump rather than a lingering effect that we had seen in the prior years on the.
To your point, Vishal, the tariff revenue has been real. We have seen a bump in what the U.S. is taking in. What does that tell you about how sticky these tariffs are for the foreseeable future? That this isn't a story of the next 4 years, but this is a tariff story that will continue on beyond President Trump.
Absolutely. I think if you just remove all the politics, midterms, four-year term, et cetera, out of the picture and just mathematically extend the clock out, yes, this is going to be a consumption tax, which is going to be 5 times more. But then companies are resilient and adjust. I think they will take some profit margin hits, slightly more profit margin sectors with higher profit margins will take a little bit more, less on the consumer side. And then consumption will adjust, or consumers will adjust as well. I know we are still squinting to see the weakness in consumption and consumer and labor market, but still there is that sort of underlying weakness that is showing up. And we do think that consumption patterns will adjust. Nominal GDP should adjust down for that matter as well.
What will it take to finally see that show up, Vishal? Because it has been some time since we've seen any of that weakness, despite the constant calls for it.
Yeah, no, I think it'll take time, and that's where it makes the Fed's job difficult. From our perspective, I think why it is difficult to see this and why it's taking time, because balance sheets, both consumer and corporate balance sheets, coming into this 2025 uncertain environment from both fiscal and monetary policy have been extremely strong. I think you're sitting on a consumer who is a homeowner is sitting on 3% 30-year fixed rate. Even the best hedge funds in the world don't get that type of leverage, and their equity is up 25% at least on their houses, and we are running a 4-decade low unemployment rate. So that balance sheet of that consumer is extremely strong to take on some of the uncertainties that we are seeing, and that's why I think it's taking time for it to seep through the economy.
Vishal, you said something in your notes that I thought was fascinating. When you bleed this into the market, you said U.S. assets and U.S. dollar are two separate trades, and this is something increasing numbers of investors are coming around to. Is that something that you expect to be persistent? Bullish U.S. assets, bearish U.S. dollar?
Spot on. I think that's how our portfolios are adjusted today as well. Over the last 7 months, we've adjusted and steered our portfolios in that direction. We're still trying to eke out that positive fundamentals from consumer and corporate balance sheets here. Not saying that there are not some of the idiosyncratic strong fundamental balance sheets in Europe and other parts of the emerging market world as well. But I think that dollar weakness, I think, is coming primarily from that, the urge from the administration. We've heard it time and again from speakers in the, not the Fed speak, but more from DC on that part. And then where the exceptionalism story is landing us, it is much weaker dollar from here rather than what we had seen probably the last decade and a half. So strong fundamentals from consumer and corporate balance sheets, weak fundamentals from the government balance sheets and deficits, which flows into your currency. And that's how portfolios are positioned at the moment.
Just about 20 seconds, Vishal. You said much weaker dollar. How much further does it have to depreciate?
I think in the next probably 2 years, we think that probably around that 10 to 15% in a basket of currencies. We are not picking one currency to go against. In a basket of DM and EM currencies, that's how we've reflected in our portfolios. We do think that there is a double-digit depreciation along the way. Again, the point being that it is not about U.S. Treasury. Foreign buyers of U.S. Treasury as a percentage of GDP has actually not changed. It is the foreign buyers of U.S. equities that are up probably 10 to 15% since the financial crisis. That needs to adjust. That's where some of the hedging will come through. And that's why we think that 10 to 15% is how we are thinking about it.
Vishal Khanduja of Morgan Stanley, thank you so much for being with us. Have a wonderful, wonderful weekend.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.